So I think we know like who's here for what. If I heard correctly, we have probably just over half entrepreneurs, a good set of people who have angel invested before, and then a few people who are curious about angel investing. So I will try to address all three groups. If you have a specific question, please feel free to drop it as we go, and maybe we either do it at the end or take it live. This specific talk and these slides have been given, I think, for quite a history of SAC. So SAC has now been going for 10 years, if I understand correctly, John. And it's roughly 2 per year, and we're at 19 right around year 10 or so. So these slides have been authored by people before me, so notable call out to these individuals. I'd also like to thank Minda Bruce, who's not here today, but as another SAC alumni. And she was the one who gave this talk initially at Amazon and attracted me to join Seattle Angel Conference and get started there. So our agenda today, we'll start with a big picture of investing in businesses and how angel investing fits in. So usually when you tell your friends or your family about your aspiring angel investing career, they're going to warn you that it's a very effective way to lose a lot of money very quickly. And there's a lot of truth to that. And we'll get into that in later parts of the talk, but the failure rates of startups is very high. And it can be a test of your stomach ability to go through these processes and see some of your startups fail. There's still a lot of good reasons to become an angel investor. So we'll kind of break that down and what that looks like. I'll be sprinkling definitions throughout the talk, including things like angel investor and accredited investor. And that will kind of help lay down the framework for the rest of the talk. Then we get into some of the angel investing landscape. This is what some of the on-ramps look like into angel investing. So the different types of investments that can happen, the different kinds of groups. It's slightly biased towards Seattle, but groups like SAC are now opening up, much more broadly. So it's great to see people from New Jersey, like Alan, present here. The previous rounds of Seattle Angel Conference have had members from Australia. I can recall some from New York as well. So even there, we're really kind of globally distributing at this point. And okay, up next, the fun part, in my opinion, which is evaluating companies. So this is an important skill set for, I think, anyone. If you are starting your own business, you want to know that your business will be successful. That's the same thing that company evaluation is doing, just from a different context. So, and even if you're working at, a larger business, you want to know that that business is going to be successful for your own career growth. So it's a very fundamental skill that's very useful in your own business development and personal development throughout. And angel investors really get to sharpen that skill. So one of the fun things about angel investing is it's done on very little data. So it's a very ambiguous area. To get started here, there's some tricks in order to cut through the lack of data that you might have with things like public companies. So we'll talk a bit about that as well. Okay, so what is angel investing? Let's start with the definition of angel investor. So that is an individual accredited investor that uses their own money to invest in startups, usually in exchange for convertible debt or ownership equity. The challenge of this definition is it uses a lot of other terms that we'll need to break down. So I'll kind of ease in with an easier definition. So like, what is a good angel investor? And that's someone who takes the time to learn how to invest in startups successfully. So I think there's a classic bias when people first think about angel investors, that there's some guy at the country club smoking a cigar who writes a check after getting pitched to on the golf course. And that's, I think if that has ever been true, it's certainly no longer true. Really what an angel investor is now, it's more of a partner, with the founder. So it's someone who takes the time to build a relationship, with founders. The angel takes time to, I think, deeply learn about, what the problem that the founder is solving. understanding like why it's a need, why their solution can help solve that need. And it's someone who very freely gives objective advice done well. And that advice should help the founder, improve their pitch, improve their business model, help them find risks, identify those risks, and help resolve them. And if that angel investor is successful in helping those founders, regardless of whether or not they invest, then that angel investor builds their brand and then becomes more successful over time because they get more deal flow. Founders will refer other founders over to these groups of angel investors and so on. So it's worth the time to make contacts. It's been called a contact sport. I kind of like the analogy because it's a very hands-on type of investment. There's a lot of these types of networking events. We've already met some, probably 30 people here today. This is indicative of the kind of thing that angel investors do, and you meet a lot of people, and we'll do a breakout session, and we'll get to network kind of after, and see if we want to pursue deeper connections later on. Okay, so the definition of angel investor included the word accredited investor. That's a formal term from the SEC, and that means it's an individual who makes at least 200K or 300K in a single year with their spouse. And they've done it for at least 2 years with a good opportunity to do it again in the subsequent year. There's also a net worth test. So if your net worth of your liquid investments is at least $1 million, then you can qualify as a accredited investor through that. There's also a trust definition, and that includes $5 million in assets. It's worth noting that in the last year, the definition was expanded, and now it includes a set of professional qualifications, and that's things like professional certifications and designations and credentials, as well as sets of employees at skilled investment type businesses. Like if you work at a VC fund, you would be accredited by default because you're an employee there. And sometimes this can be a formal check, and sometimes it won't be. So sometimes you can self-certify and claim that you're accredited, and that's all the proof that will be needed. So there's a Regulation D that defines the exact rules of engagement of when it's going to be worth the effort to go through the formal verification and when self-certification is okay. And typically when you do need to certify, it can be as simple as going to a third party and submitting your last 2 W-2s through a secure portal, for example. And they can turn that around typically in even hours. So not necessarily a heavyweight process. And if you're here and you're not accredited, that doesn't mean that this talk isn't for you, even if you do want to be an investor. So there's another recent regulation called CF, or Regulation Crowdfunding. And this enables eligible companies to offer and sell securities through online fundraising. So I think the best in breed example of this is WeFunder. We're even seeing a lot of the SAC companies that are coming through not only pursue accredited investors through something like SAC, but also to list on WeFunder and try to crowdsource, I think, smaller checks from a wider variety of investors through that means. There's other rules on Regulation CF, like a company can't raise much more than $1 million in a 12-month period. So it's still useful to become accredited and become an active investor through that. Okay, so angel investors invest in startups. What the hell is a startup is the next question. So a startup is a company which takes outside capital in order to achieve a liquidity event, usually with an N multiple return, with a time frame of a decade or so, and potentially even longer. And how does that contrast with a small business? So if someone is starting a small business, what does that mean? That typically means that that's someone looking to run an ongoing business without planning for large growth, and therefore they don't need to do a large fundraise in the same way a startup would do. And they're also not planning necessarily for a liquidity event. So in practice, that means a small business is more likely to be an LLC or an S Corp. And that means a startup is much more likely to be a C Corp. And if you're here as an entrepreneur and you initially started with an LLC, but now you realize like, oh, I want outside funding. One of the first things that an investor is going to ask you is, can you now switch to a C Corp? So we generally like to see that as early as possible because we know for subsequent funding rounds, if a VC comes in, a VC will demand that it's a C Corp. So it generally makes more sense to have your C Corp ready kind of in the earliest phases. So as soon as you know that you want to be seeking outside funding, go with the C Corp. It will save you headache downstream. There's also growth. So startups don't remain startups forever. Eventually they outgrow it. There's a Techcrunch rule of thumb, which is a 50, 100, 500. And what that means is if a startup has $50 million in revenue run rate, or if it has 100 or more employees, or a $500 million or more valuation, then it ceases to be a startup. Okay, so I'm already starting to mix in the term venture capitalist or VC. So how is a VC different from an angel? VCs are people who generally invest other people's money. They're not typically investing their own money. And that also means that they have large amounts of money to deploy because they're pooling a lot of other investors' money. And those are typically affluent investors as well who have a lot of money to deploy. And it's just with the rule of larger numbers, it's harder to allocate larger numbers into smaller companies. So what you'll find is, let's see, angel investors are more likely to invest in earlier stages and smaller companies with smaller amounts of money. The typical, I think, critical mass check size of an angel is around 25K. But I'll get into other examples where that can be as low as 5K, sometimes even as low as 1K on a platform like AngelList. But generally 25K starts to be the sweet spot of when people start writing their own checks to be on a cap table, for example, with a startup. Sometimes that can be larger, like 50K, 100K, and it can go up from there. So that's roughly kind of the angel investor terrain. And then the VCs generally are deploying, more likely to be on the order of millions of dollars. They'll raise a fund. That fund can be up to, say, $100 million. And then they need to deploy that $100 million over several years. So law of large numbers. VCs, in order to get a good return, they really need to hit a home run somewhere. So VCs are more likely to be only looking at kind of that unicorn style billion-dollar exit in at least some of their portfolio. I think what you find with angel investors is those smaller possibilities, like let's say a $50 million exit, that may still be very attractive to an angel. Whereas if you go to a VC and you say like, oh, I'm looking to exit around 50 million, that angel might not be very interested from that moment. So, or that VC, excuse me. So that I tried to break it down into a life cycle of 3 parts. So we have the early stage rounds. That's like the friends and family type rounds and the seed rounds. Then you get these later stage rounds where the VCs come in. And then you get public companies, which is where the public investors come in. So this slide kind of indicates the earliest lifespan, more towards angels, kind of that middle private lifespan, more the realm of the VCs. And then post IPO or post SPAC or however the liquidity event happens, then it's registered with the SEC, and then the general public can come and invest. So those early rounds, typically, at least in the Seattle area, we see 2 forms of investments which are very common. So those 2 types are convertible debt and equity. So convertible debt is exactly, it's a form of debt. So just like any other debt, there's a loan. That loan has a term and it has an interest rate. So that's something you could go to your bank and receive. Typically, startups and angels aren't interested in just the loan. So what they want is a convertible note or convertible debt. And what that convertible debt does is it changes that loan into equity. And that's typically done in the next funding round. So because that angel is also taking some risk by going in earlier into the investment, they usually want a discount. So they'll give you money today, but they'll say in exchange for kind of going in early when there's more risk to my investment, I would like, say, a 20% discount, on the conversion. So there's the interest rate, in the interim, and then on conversion, it goes into the discount. And there's one other thing that you'll find with convertible debt, and that is the concept of a cap. And basically what the cap does is if you're wildly successful between now and your conversion, that angel doesn't want to invest at, say, 5x, over the next 6 months or 12 months or 18 months. They don't want a 5x investment value, which really kind of diminishes the risk that they took, in the interim. So what the cap does is it basically says, like, no matter what the price of the next round is, I will set a cap at this value. And when my conversion happens, I'll be in at no worse than that cap. So it's a great problem if your cap happens. That means your startup is being wildly successful. And equity. So equity is, I think, the more, I don't know, that means like you actually issue shares and the angels own shares. So some startups don't like this because there's a little bit more legalese and paperwork in order to get equity. But I think for aligning incentives, if you really want to align your investors with the outcomes of your founders, then you generally want an equity offering. So raise your round as equity. And that means when the founders win, the investors win, and vice versa. So it's the best alignment. And the downsides are the paperwork and potentially the additional legal costs up front.
So Greg, we have a question from Carrie. Carrie, you want to ask your question?
Sure. Hi, Greg. Thank you for spending time explaining this stuff to us. I had a question about, so I'm from Los Angeles, and an instrument called SafeNote is becoming very prevalent here, especially with the companies that have gone through accelerators like Y Combinator and Amplify. They all seem to be using SafeNote. So just wondering if you had any thoughts on that.
Yes. So a SAFE is a simple agreement for equity, and some of the standard docs like Series Seed, you'll see like some of the standard docs that like Y Combinator and other incubators use, refer people into these SAFE agreements. So we don't see that very much in Seattle, and I think there's a couple reasons for that. And it's primarily because it does not well align what the investors would like with the outcome that the founders would like. So for example, there's a well-known example in the Bay Area where there was an angel investment round, and they raised a bunch of angel capital under a SAFE, and that company became profitable without needing to ever raise a later round. So what that meant is the angel investors ended up with a bunch of coupons for equity for a fundraising event that never happened. So that founder actually has, entire ownership of his startup still, and it looks like that's going to be that way in perpetuity, without ever returning a positive outcome for the investors who invested their own money and took that risk. So like there's well-known downsides. I think it does make sense in two circumstances. So one circumstance is if you're doing a very early friends and family round, kind of giving that coupon for an IOU, which is, kind of what the SAFE is. If you have known your friends and family for a long time and you're doing a smaller raise as you kind of prove out an idea, that can make sense in that scenario. So very early rounds. And then there's another scenario where, your startup is wildly successful already and investors are really competing to get into the round. So this happens often in places like YC. There's a lot of visibility to those startups, and a lot of investors want to get in. If you have that kind of competition, then a SAFE can basically help you, raise money quickly under your own terms, and get you moving fast so you can move on from your fundraising without further ado. But I would say in all other circumstances, you probably do not want to raise a SAFE. And there's going to be regional differences here as well. Like, I don't know about LA, but it is more common in the Bay Area, for example.
Cool, awesome, thank you.
Sure. Okay, so up next, the angel investing landscape. So still the most recent statistics that I could find, our angels are investing about $21 billion across about 64,000 startup companies per year. And compare that to what venture capitalists are doing. They're investing about 4 times more, or 84 billion, and 8,000 companies. So 1/8 of the companies getting 4 times the money. And about $25 billion of their investment were still in seed and early stage companies. So they're still going, to those seed rounds. I think oftentimes what the VCs are doing when they invest early is they just want, their name on the term sheet. So when those later rounds happen, they can deploy more money. So a lot of times it's kind of like a party round where, VCs put in a small check, and then they wait and see if you're successful. And if, come around for your Series A, they're going to want to lead that Series A, and they already have the working relationship with you in order to do that. Looking across the country, angels are active in disparate amounts. So your eyes might gravitate first towards California, which is almost 1/3 of the country's angel investing. That's driven primarily by the Bay Area, but LA's holds its own weight as well. Up here in Seattle, we're smaller. People like John Seacrest are looking to address that through Seattle Angel Conference, which is looking to mint more angel investors and prepare more startups to successfully fundraise. So that's the charter of this organization in improving and boosting that number. These boundaries are starting to matter less, as I kind of led with. I can think of like a food startup from New York who found us in Seattle Angel Conference, for example. But there was a good handful of startups from all across the country. We also get some startups from BC. I don't know if they generally come across Canada, but certainly from British Columbia. Those companies have come to SAC and been successful there as well. So angel investors generally talk to a lot more companies than they ultimately choose to invest in. So the ratio here that's called out is 1 out of 30. And that also means there's a lot of good companies that don't get funded, but there's also a lot of companies that aren't good angel investments, and those might still be good companies. So for example, like all those small businesses that we kind of spoke about earlier, those aren't necessarily investable, but those can still be good companies on their own. And the risk of angel investing is because we invest early and with such ambiguity, the failure rate is going to be very high. So, at least 50%, if not more, can be expected to return, not the money that was put in. And quite a few of those are going to return 0. So, what are the reasons that startups fail? Well, there's, overall 50% just go out of business for whatever reason. I have a later slide which details that more. But other outcomes are things like sales to larger companies. Acqui-hire. Acqui-hire is generally a better outcome for a founder than it is for an investor. So that generally means that, what the company built on its own wasn't necessarily useful, but something like a tech giant would be interested in, taking your tech talent on board and using you internally to kind of build out what you had built for its own purposes. That's generally a smaller exit as well. And that can be good for the founders. It can or cannot be good for both the employees of that startup, and the same thing is true for the investors present. If your eyes go all the way down to the bottom of the outcomes, there's this initial public offering at 0.1%. And I think that's probably roughly still accurate. And the next question should be like, if that's the event that we all want, and that's only 1 out of 1,000, why should we angel invest? I think a part of the reason is IPOs are happening later and later. So when, say, a Microsoft went public, its initial market cap was about 350 billion. And then fast forward maybe 10-ish years to when Amazon went public. Amazon went public at 438 million. So still a very small IPO size. And that means all the upside, from both Microsoft and Amazon from, half a billion to what, just under $2 trillion nowadays. All of that wealth was created in the public markets. But companies are not going public at the same point anymore. So if you look at, say, like the Ubers or the Airbnbs, like these are companies that are now IPOing, in tens of billions of market cap by the time they hit the market. Facebook had $104 billion market cap by the time it went public. So the people who invested in Facebook's IPO, they haven't seen nearly the upside as those like initial investors in places like Microsoft and Amazon. So because a lot of that wealth is being created in the private markets, angel investors are trying to tap into that wealth creation and really trying to get that exponential growth. So there is money to be made in angel investing. And there's research that states that a 25% annualized return is a reasonable goal. And if you don't achieve your goal, maybe a rate of 20% or 15%, like those are very, very feasible returns for an angel. And it can also be a part of a diversified portfolio, so you can decrease your overall risk profile of your portfolio. Even though those micro caps, may not be as accessible through public markets, an angel investor can still access that portfolio distribution by pursuing the private markets there. So here's a slide that discusses angel investing returns and what they look like. So this is a study that was done that showed, let's see, most outcomes are less than 1% returned. So roughly around 70% there. And then you get a hockey stick of returns as you get to 5x and 10x, all the way up to 30x or more. So most of the return is going to be driven in an angel investor's portfolio, really just by a very small subset of winners. So the person who, is starting out with, angel investing through AngelList and doing 100 or 200, they are likely to hit some home runs with a portfolio that size. I'll break down into what portfolio size makes sense. It doesn't necessarily need to be 100 or 200. That's bigger than mine, for example. But as you grow out that the raw numbers of startups that you invest in, assuming they're high quality, the odds of hitting that home run increase. This chart basically is distribution of returns by investment, and it talks about how the age of the investment correlates with the amount of growth that you see in the investment. So that less than 1x return, it takes roughly a 3-year holding pattern to see that less than 1x return. So in other words, as you start to angel invest, you get your data on your failures first. So looking forward to the time that you cut your first angel check to several years in the future, you're going to get a lot more negative data that you're failing and that you're bad at this. And that's just the shape of the realities of the distribution curve. So if you hold on to that 5-year mark or 6-year mark, what you'll find is like you're going to see those subsequent rounds come in, and you're going to see those up rounds happen. So then you're going to start to get the full set of data about how effective you're being as an angel investor. Yes, John.
I see that Noel has a question.
Yeah, I'll put this out here. I don't know. Something I get very confused about is this IRR and the 10x or whatever X terminology.
Yep.
And because my basis of understanding is like a mutual fund. So, and an angel investment works differently because I might not see any return on my investment for 10 years, right? It might be 10 years before I see the return. So let's say there's an IRR of 10%. And after 10 years for this investment, and after 10 years, I see my return on that investment. Does that mean that I basically made 10% a year over 10 years on my money that I invested? Or does it mean, what does it mean? I don't know what it means.
Yep. Okay, I can give you the equation. I have it deep in my appendix, but I think it's like 1 minus basically the number of years that you held it divided by. Let me jump to the slide. I probably won't get it right perfectly from verbatim, but as a rule of thumb, if you're going to stick with me at that level, yes, if you had a 10% IRR, and you had a 10-year hold, that would roughly mean that you had a 10% annual return throughout that investment's life cycle.
Okay, perfect. So that's yeah, got it. Thank you. And I assume that is equivalent to the something X also. That basically IRR and something X are just different ways of saying an amount.
Yeah, there's like return on investment, which is a very similar metric, and that's like if you had a 10x return, you would subtract the 1x that you put in, so your return on investment would be 9x for a 10x return. So it's a very similar concept described.
Different way of presenting the same outcome.
Yeah, exactly.
The important thing to note is that an IRR demonstrates time, where return on investment does not include time in the calculation at all. So your investment where you get a 3x return in 3 years is a very different investment than if you have a 3x return in 20 years.
Yeah.
But if I'm expecting to make 5% investing in the stock market and an index fund in the S&P over 10 years, I'll be making a lot more if I invest in some number of angel companies and cumulatively have a 10% IRR.
Yes, and on average, people that do good angel investing habits are seeing between 22 and 25% returns.
Thank you.
Okay, so why you would do this? Angel investing is a lot of fun. So if you enjoy this kind of event where you gave an intro and you met other people, and you got to talk about other people's startups, you got to talk about your own ideas, that's probably a good batch for that demonstrates that you will be happy as an angel investor. So if you're if you get a passion inside of you, like learning about companies, like what makes them tick, how they're going to succeed or fail, and potentially giving founders inputs into what might make them succeed or fail, then you can make a difference, and you're likely to enjoy what it is to be an angel investor. So something like SAC, actually based upon what this meeting was, like Seattle Angel Conference is very similar to what we saw tonight, where it's founders and investors talking, and a breakout session afterwards where we can go into more detail. It's as a percentage of your portfolio as well. Like generally, it takes the most work. So the advantage of that S&P 500 index fund is you can dollar cost average into it with very little thought. It's very hands off, and you'll get the market's returns, and those are going to be very good, probably better than median returns without any extra effort. With angel investing, you do want to actually have the passion. I wouldn't recommend going into angel investing because for 5 or 10% of your portfolio, the amount of time that it takes, may just not a fit for some people, and they would find that they don't enjoy that. Okay, so for building your portfolio, before you start writing checks, as an angel, it can be very exciting when you're getting pitched to and you want to, you believe the marketing pitch and you get excited by the founder. So you're ready to take out your checkbook. But the best practice is don't write a check, maybe even for your entire first year. So watch a lot of pitches. Start to understand objectively what a good company looks like and a bad company. And then start to pace yourself to build a diversified portfolio. So the next slide, we'll talk about what portfolio sizes look like, but right around 20, you really start to see the distribution curve flip into your favor. So even with, I think, about 5, if you have 5 companies in your portfolio, it's roughly a 50-50 chance of breaking even. So still not a very good outcome. But as you get more and more, that probability of a better outcome increases for the angel part of your portfolio. And asset allocation wise, you'd want about 5 to 10% of your assets. That's one method that angels use. Another method that some angels use is they look at their incoming free cash flow. So take your RSUs or your other income coming in, and then set 10% aside, after you've paid for your living expenses, and use that for your ongoing investments into angel investing.
I see a question
Okay.
in the notes about any suggestions on structuring an initial investment so you're not squeezed out in subsequent rounds.
Yes, that's advice that John gave me, and that's stick to standard terms. So be very careful if you start to redline the standard documents. As an angel, generally those red lines are all done because someone's playing chess. And what you don't want to do is play chess, because you may only have 20 or 100 deals, and the lawyer that's writing these agreements, they may be doing thousands upon thousands of deals, so they've seen it all. So as soon as you start to agree upon, I think, changing the standard terms, that's when you can have negative outcomes in things like later rounds, where all of a sudden the existing investors get diluted in a big way. So just stick to the very simple, plain terms that you'll find on websites like seriesc.com, and proceed with them, and that will keep you safe without needing to hire a lot of lawyers in order to make sure that you're safe.
At least as safe as you can be, because there's always the possibility of people messing things up later.
Yeah. And the other thing is the basis of trust. Like, make sure that you trust the founders. So there's some SEC protection as a part of like that Regulation D that I talked about, where if they're a known, if they've been convicted of a fraud, for example, they would have to disclose that to you as a part of the regulation. But generally, it's really like a trust-based relationship. So take the time to get to know your founders, do your due diligence. There's some slides later on due diligence. Those are the kinds of things that you want to learn about as you kind of spend the 20 plus hours learning about your investment before you cut the check. So this chart shows how the probability of a good return increases as your portfolio size goes up. So we have the red line here that shows if your portfolio is 5 investments, your percentage of a 1x return is about 50%. So not a very good outcome. As you scale the size of your portfolio up to either 10 or 25 or 50, let's see, it looks like around 50, the probability of a 3x return is now 50%. So that trend continues as you go out to 100, but you can see that it starts to diminish very quickly. So the rule of thumb that I stuck to, and like Jason Calacanis, who's got an excellent book on angel investing, so he recommends pacing yourself for 20. So make sure that the checks you're writing are sustainable, that you can actually write 20 of those checks. And here's, showing what this looks like in practice. We have 10 companies labeled A through J. 5 of those go through 0. A couple are just a 1x return, don't really do anything. H and I start to have better returns, but then the entire returns to this portfolio are driven by that company J. So make sure across your portfolio that you have the potential to have some J's. I's and H's can still be okay, but it's worth it for the moonshot. You can fail 5 times, that's perfectly fine, and as long as you get your moonshot in an example portfolio like this, it's still a fantastic portfolio and fantastic return. Okay, we talked about check sizes. If you do the math on that 25K check, let's say you want to write 20 checks of 25K. That's what $500,000 in angel investing, if my brain math is correct. If that was 5 or 10% of your portfolio, then let's say it's 10%, you would need a net worth of let's see, $5 million to support that. So that's a very big check size. If you don't have that kind of net worth, you can still angel invest, but scale down the checks that you choose to write. So if you're writing 5K checks, you can write 20 of those. That's 100K total, and that would be 10% of $1 million portfolio. So it becomes much more reasonable to kind of get that diversity of exposure with smaller checks. And the way that you can typically make it worthwhile for founders to take 5K checks is you team up with other investors who are also writing 5K checks. And then the sum total of the check that you write is the sum total of everyone's check. And that's a single entry on the term sheet. It's nice and clean. And what these look like in practice, those are syndicates. Syndicates are things like AngelList, where there's typically a VC or a lead syndicating the round. They're going to take some carry for that. So they take 20% carry. That's still an effective way to write smaller checks. What is popular in Seattle is kind of pulling together as an investment group. So Seattle Angel Conference is an example of a 5K check. So all the investors in SAC will pool their money. That usually goes to 1 or 2 winners. If investors like other companies that are participating in Seattle Angel Conference, then there's something called sidecars. So someone in SAC, spins up a sidecar, which means they're going to form an LLC. They take all those 5K investments, and then the LLC makes a single investment on the term sheet. So that's a very effective way, typically without charging any carry. There's the legal fees of setup. So the investors write a little bit bigger check than the 5K to cover those legal fees. And then that entity, eventually will return in the event of a liquidity event. So tricks to improve your returns, investing in what you know. It makes sense in public markets. It also makes sense in startups. So this slide indicates that when there's an overlap in industry expertise, that the investment returns generally go up. So, as a personal example, I don't know a lot about, say, biotech or commodities or pharmaceuticals. And I don't even know what my blind spots are in those areas. But I do have expertise in things like technology and AI. I've become an expert at e-commerce just, by working at my day job. I know voice computing very well, for example. So these are areas where, I have a better opportunity for success if I'm investing in areas that have an AI story or a technology story. So give yourself that head start and make yourself successful. Another advantage of, those kinds of pooled investments is you gain a hive mind. So even if you're not an expert in AI, if there's someone else in your sidecar who is an expert in AI, then you have that expertise in place and you can bounce ideas off of them. And you ideally provide your own expertise. So that might be in, say, marketing or social networking or whatever your expertise may be. That entire sidecar is the sum total of all those experts. So you're more likely to have a good outcome by kind of pooling and sharing your expertise. Another part of the equation for successful outcomes is spending time on due diligence. So if you spend at least 20 hours in total in your due diligence, you'll get a 2x better multiple according to a study here. And that's interesting. What just caught my eye is the less than 20 hours of due diligence can have a better outcome at the 30x amount, if you look carefully at that slide. I would attribute that to people being willing to take a big risk on a moonshot idea. So what can be dangerous about due diligence is you can find a lot of reasons to say no. So when we take a step back and describe what due diligence is, this is a process that investors and founders go through together. So the investor asks the founder to provide a bunch of documents about, say, like their accounting system. Show me your balance sheet, show me your income statement. And what the investor does is they go through all of those documents. And then they ask a bunch of questions, oh, what's happening here? Like, can you explain this? And the founder, basically bears all, and they say like, oh yeah, we made a bad investment. So, we had to write off, some money there, or we pivoted. So that was from our previous, idea before the pivot. So you're going to see some remnants of that, kind of lingering around in our documents. You might find like on a term sheet, like the due diligence is going to look at your term sheet and see like, okay, who's on your cap table to date? So that cap table might have an ex-founder. So you'd find things like, oh, 25% of the ownership of your company is going to someone who no longer works at the company. That's going to concern those future investors. So I think the goal of due diligence is not necessarily to say no, but it's to have an assessment of the risk that you're taking and being aware of those risks and making sure it's a purposeful trade-off. So I already started to talk about a lot of the angel investing options. There's plenty more. There's things like lone wolf investing, which is just going on your own. We already talked about some of the angel networks. We talked about sidecars. In the Seattle area, there's active angel groups. So there's groups like Sea Change, and what they do is they pool investors over like a period of time. I think it's 1 year. And those investors write, a $50K check to participate in that year's investments. And then it's a very collaborative, operation among all the investors who participate in Sea Change, where they then go and invest the sum total of all their money throughout that 1 year. And then start the next year, they do it again with an additional raise. We talked a bit about online platforms. The other, I think, really interesting one is these angel networks. So a lot of people like myself have gone from Seattle Angel Conference into some of the angel networks that kind of graduates typically go into. So one example is Grubstakes. Another example is Mercer Island Angels, which is also one I'm active with. But what these groups are, it's people, angel investors, who share their deal flow. So when you find a founder that you're interested in talking more to, normally with that founder, I would say like, hey, like, would you like to chat with other angels at the same time as you're talking to me? And if the founder says yes, then I would, invite one of these angel networks along with me. So, we might get, say, 10 investors on the call. And then all of us will be asking questions, and all of us will be discussing pros and cons. And generally, if some subset is interested in investing, then they figure out how to proceed. So that can mean that a lead investor comes out of the network. So one of the investors chooses to be the lead role, and that means they're going to negotiate the terms. Sometimes there's already an established lead that the angel wants to work with, in which case there might be something like a sidecar investment if people are writing smaller checks, or it might mean that people want to just collaborate on the due diligence process, for example. But it's a collaborative way to invest, and it's generally more efficient for founders, and it's a safer bet for the angels participating in those groups. So I think people here all know about SAC. There's a few personal friends of mine, so I won't gloss over this entirely. But what Seattle Angel Conference is it typically, matches a group of investors with a group of startups. And that's usually starting around 50 startups, probably similar amounts of investors. I think it's roughly 40-ish. And then, there's a round of filtering and some networking events. Everyone does a Gust profile to kind of talk about what their business is and how it works. And then the SAC investors do 3 rounds of voting. So whittling it down to 24, and we learn a lot more about 24, and we get detailed pitches of those 24. Eventually, it whittles down to 6 finalists, and all those finalists are going to get a full due diligence process, where that 20-week kind of deep dive into the books and whatnot, and fully understand if the company is investable or not. So the result of the due diligence effort in SAC is it's a yes or no. Yes, we view this company as investable, or no, we think the company is not investable at this time. And then finally, there's a fun conference type finale where the finalists all pitch again, and then the investors meet offline to vote, and then they come and announce a winner in kind of a fun, competitive type atmosphere. It's not necessarily winner take all though, because there's sidecars, and that finals event, or the Seattle Angel Conference proper, like other investors are present there, and there's a lot of networking opportunities there. So if another investor sees your pitch and they get excited, they're going to want to chat with you and talk to you and set up an offline meeting to go into more detail and hear your full pitch. SAC also creates fund managers. So once people graduate from being individual investors, then they're ready to be either an assistant fund manager of a future SAC or a full fund manager of a future SAC. And that's more about what it is to raise a fund. So if you have aspirations of raising a VC fund someday as an investor, you can keep pursuing in the SAC learning process, and you still become a VC or fund manager. So there's other opportunities as well. We started talking about the Health Life Science Angel Conference. I'm sure we'll probably do a breakout session to talk about this more, but this is a version of SAC specific for health and life sciences. So assessing interest right now over the next 2 weeks for a go, no go. And John and others are looking for health and life science startups in order to reach a critical mass there. There's also a Northwest local food ecosystem pitching event coming up. That's on March 10th. And what that will be is it's a pitch event. John's looking to raise some money for a winner of the pitch event as well. So if you want to pitch in some money there to keep the event fun, then please do so. But if you'll be pitched to as an investor, and it's another opportunity to meet people in that industry. And the SAC finals that I mentioned, that's upcoming on May 12th. So mark your calendar and go to the website to register if you're interested. Okay, evaluating companies. Looks like I'm roughly at the 1 hour mark, so I'll start going faster at this point to keep things moving. So the 3 reasons that startups fail: there's market-related failures, there's team-related failures, and product-related failures. And there's a lot of subsets of those. Contrast that to why companies succeed. That's generally because they have very good timing. So this catches a lot of people off guard, but the biggest factor in success is having the right idea at the right time. So if you think about something like self-driving cars would have failed 10 years ago. We needed, the tech to improve, like the cost of LiDAR to come down and other kind of consumer technology there. in sensors, you needed the deep learning possibility in order to train models that can make that safe. So there's suddenly a day where the next startup, with the right team and the right product can succeed in that. And that's going to be one of those, great returns. So timing is super important. The team, first and foremost with the founder, but also with the founder's ability to hire out a successful team that can deliver. Ideas are less important. I don't put much weight on an idea, in the lean startup ideology. It's all about execution of ideas. That's what matters. So focus on the output. Don't focus on the input there. So, yep, what makes a great company? So what we look for in investable companies is, that market opportunity, knowing that the product or solution matches the market opportunity, and that the team is the right one to deliver upon it. Having some evidence of traction, especially in an event like SAC. So oftentimes, in order to kind of whittle down the audience, or to whittle down the 50 companies into less, to smaller numbers, things like traction start to become really important. So to do well in SAC, it's not always required, but if you already have some traction coming in the form of LOIs or actual revenue, that's a very helpful signal for investors. Yep. So execution of business model, and the evidence of the team being able to execute. So being able to demo, not just having an idea, but showing that you've actually built out an idea, for example, when you can demo the idea. That's all very useful. So we already talked about due diligence a bit, so I won't reiterate. I will share my own personal investment principles. So when I started investing, I realized I wasn't keeping a paper trail of kind of the reasons why I was or wasn't investing. And this would mean, like, sometimes, there's a follow-on round, or, you learn about a unicorn, and then I wouldn't be able to go back and follow, the principles that have led me to either invest or not invest. So what I've started being diligent about is, when I, speak with the founder, I go and I fill out my principal list, which I've whittled down to just 5 now. I keep trying to whittle that down more and more. But I'm looking for things like the founder market fit. I have a quick way to assess financials, and that's me saying, can I envision this company getting to $100 million revenue run rate in the next 5 years? And then how could I unpack basically how that team can get there? And that doesn't mean I'll necessarily do that for every investment. There are those smaller exits which will still attract me. But if I'm thinking about the risk-reward ratio, it's much more tangible for me to kind of unpack this $100 million revenue run rate problem. So the questions that I ask are generally like me trying to fill in, how can this company get to that $100 million revenue run rate that leads to very successful outcomes? So also, product fit. So, all that traction that I mentioned before, the LOIs, do they have paid customers? That de-risks an investment greatly. Trust. I wanted some way to force me to think about trust. And this is, when I hear a pitch and I hear something that leads me to a trust signal, I might follow up on that, or I might choose to dismiss that founder outright. So this is just one of those things, because it's so high trust to kind of share this level of access with one another. I have a veto on trust. And I also like to make sure that the team, the rest of the team is a good one. So I like to meet other people kind of sitting at the table with the founder that they've hired on. And then there's the timing part, which, looking in COVID, when SAC 17 happened, COVID was just beginning. And all of a sudden, the risk profile of all of our startups changed very quickly. So this kind of led to a survivability, assessment, which is knowing, the headwinds that we're going against, is there sufficient survivability based upon this idea right now? So I also have a principle for that. I'm willing to share these offline and talk to them more in the breakout sessions. So let me summarize where we got to. So good angels can make money. IRRs of 25% are possible for angel investors. And those returns are driven by a small percentage of your portfolio. So you should only invest a small percentage of your overall net worth or your overall free cash flow into angel investing. And performing due diligence increases decreases the numbers of companies that will fail in your portfolio. So take the time for due diligence. It's worth it. And yeah, the Pacific Northwest is a great place to angel invest and also beyond. So, and one disclaimer and one reminder. So invest in those 5 or 6 companies to get to a 50-50 outcome. So pace yourself. Probably don't write any checks unless you think you can get to 5 or 6. And ideally pace yourself to get to 20. And everything I've said, I'm using a lot of rules of thumb here and grains of salt. So one last reminder that there's no guarantee of those investment returns that I said. That's taking the studies into effect and making sure that you do the due diligence process appropriately and that you do your best effort at vetting with a team of experts to make sure that the investments are good. But if you do all those things and you learn how to be a good angel investor, then I do think it's feasible, and I'm okay sharing with you all that a 25% IRR is possible. And here's some quick resources. If you want to take a print screen of this, go ahead. There's some books on how to angel invest. I also recommend the Venture Deals free online course, which is starting very soon. You can contact me if you'd like a pointer to that, and I'll send it to you. Okay, and reminder that the SAC-19 deadline for startups is February 25th. So if you're not yet participating in SAC and you want to as a startup, do so by then. And yeah, with that, I think we can break out for questions.
Yeah, do people have any questions they want to ask now?
Greg, could you just go back one screen? So I wanted to take a picture of that reference. And then I just had a question about hardware companies. What's the percentage of investment into hardware? I know software is like the big buzzword lately.
Percentage, I don't have a statistic handy. I can talk about my own approach to hardware, which is like the barrier to entry is higher than software. So I think what we've seen with software is a lot of the low-hanging fruit of a pure software play. Like just generally speaking, you're getting more and more siloed kind of as software maturity increases. And also the barrier to entry to creating software startups has gone down with cloud computing and other similar innovations. So you can get started with a very small amount of money to prove an idea there. Over on the hardware side, that's there's just, it's more capital intensive to prove out an idea there. So as an angel, I probably still, I think, have invested more in software than I have in hardware, but I'm happy to invest in hardware. I think that moat is attractive. And it also means that you need angels. So like we're more likely to collaborate one-on-one. But yeah, I would say it's probably on the order of 10-ish% of the investments I have done.
Thank you.
I see that Noel has a question.
Yeah, hi, thanks. That was really great. That was very, very helpful. And I particularly liked the slide where you were talking about different ways to invest, different opportunities for investment. And that's something I've been thinking about a lot. Like for me, in my situation, what makes the most sense? And I want to invest maybe 50,000 to 100,000 a year. So that's like, 5 to 10 years to get to 20 companies, which seems like a long time, which is why some of the funds like that, I think you used the term passive funds, that has a lot of appeal to me because I can make an investment and start to get some diversification right away. And I'm it just seems to make so much sense to me. Maybe it's because I've been investing in index funds for so long. I'm wondering, what is the downside? Why would I not want to do that? Unless I really think I am, which I don't, I can pick out a major winner, or unless I really like the process of going through and meeting with folks and mentoring and doing the due diligence. It just seems like it makes a lot of sense to put my money in a fund. I realize I got to pay somebody to manage that fund, but still, just I'm wondering why I wouldn't do that. Is there any reason?
So yeah, like it's not even mutually exclusive. Like you can do, you know, one or both or all options. I've chosen to do AngelList syndicate investing in order to kind of reach, you know, my critical mass portfolio. And now when I'm writing kind of larger check sizes, I'm comfortable with that because I've already achieved that diverse platform. So it gave me the comfort to, you know, hit the range that you're referring to with the check size. But specifically when it comes to investing in funds, there's a wonderful, I think it was the University of Texas, that because they're a public institution, and they have an endowment which is invested in many different kind of funds, they returned, you know, all their data on all of the returns that they had achieved. And it was enlightening for me to see because I didn't see a lot of predictability in like the actual returns of funds. Even with the name, like you might have a top tier investment fund, and they're getting big money from big endowments, like, you know, these universities, and they're doing, you know, a new fund every few years. You might find 3 of those funds have, you know, terrible returns, and then the 4th one has this, you know, huge, like, you know, skyrocketing return. So it's all about whether or not they hit that one home run. Like, you know, did they find the Google? And if they found the Google, then they're going to be famous, and, you know, they're going to have an easy time, I think, raising additional funds kind of, you know, indefinitely. But that doesn't mean all the other funds, you know, that they've achieved have actually, you know, hit that return. There are some other tricks that these like fund managers are doing, and that's things like the high conviction fund. So, you know, they write small checks into startups, you know, in the angel rounds, and then they start to see like who, you know, who's being successful, and then they write much bigger checks immediately in something like the Series A. And I think the early data is like the funds who are doing that kind of approach are, you know, more consistently hitting better returns. Yeah, let me share with you the raw data that I've seen. I'm sure I can dig it up. And anyone else who wants to contact me, I'm happy to
That would be
share that,
great.
that document.
Thank you.